In today's video, we will learn about how Turkey shocked markets after declaring a rate cut despite the alarmingly high inflation rate. How will this affect their currency and their economy? Are we seeing another economic collapse? Despite the fact that the country's inflation rate is already close to 80%, Turkey's central bank startled the markets by lowering its benchmark official borrowing rate. Following the news, the Turkish Lira fell by 0.9% against the dollar and was trading at close to a historic low of more than 18 lira to $1. In a dramatic divergence from what other central banks are doing globally, the country's central bank announced in August that it was reducing the rate from 14 to 13%, which shocked the financial world as experts did not expect that Turkey would continue with this policy of reducing rates at the time of extreme inflation. In order to attract much-needed investment, Turkey's government has made a show of diplomatic overtures to a number of oil-rich Gulf governments. Despite Western sanctions and Russia's invasion of Ukraine, Turkey has remained fervently open to Russian industry and trade. Analysts anticipated no rate adjustment, thus the Turkish central bank's decision to lower rates surprised the market. According to statistics from Reuters, the main BIST index lost session gains and traded 0.8% lower after the judgment before turning positive and rising 0.2% in the hour that followed. In a statement released, the Turkish central bank stated that there are indications of a loss of momentum in economic activity and that the committee anticipates the disinflation process to commence. As the nation struggles with rising food and energy prices, as well as President Recep Tayyip Erdogan's long-standing unconventional monetary policy strategy, Turkey's inflation for the month of July increased by an alarming 79.6% year-over-year, its highest level in 24 years. The lira was trading at 3.5 to the dollar at this time 5 years ago. Today, it is trading more than 18 to 1. The outcome has been a failing currency and significantly reduced purchasing power for the typical Turk. The value of the lira has fallen by 27% this year versus the dollar and by 80% over the past 5 years. Erdogan gave the nation's central bank instructions to regularly lower borrowing rates in 2020 and 2021. Despite inflation continuing to grow, observers claim this central bank lacks independence from Erdogan. Opposition expressing central bank governors were dismissed. By the spring of 2021, Turkey's central bank have had 4 different governors in that time. The nation, which serves as an important economic and political hub between the East and the West, is home to millions of Middle Eastern and South Asian refugees and has the second largest military in NATO, now also has a growing current account deficit. For the Turkish currency and the cost of living for Turks, country watchers foresee either another cut or at the most, a hold. A rate drop of 100 basis points is forecast by economists at London-based Capital Economics. In the meanwhile, analysts at the investment bank MUFG anticipate a hold at the present rate of 13%. The lira, which has already declined 27% versus the dollar this year to date and 53% over the past year, will continue to plummet, according to economists who also forecast sustained high inflation. Erdogan, on the other hand, is still optimistic and believes that inflation will decline by year's end. Inflation is not an insurmountable economic threat. I am an economist, the president declared in a press conference. Erdogan, though, is not a trained economist. Turkey is attempting to change the situation, but the current policy it is using is ineffective. As things get worse, it's actually encouraging further inflation and price increases. The trade balance is deteriorating. Turkey needs to find a way out of its current predicament since it is further in debt and is running out of money. One option is to work with Russia and import cheap fuel, food, and other supplies that Russia can provide. It might provide Turkey with some relief, but if Turkey decides it wants to agree to additional deals and purchase more goods from Russia, there is a talk of changing some of these contracts so that they are paid for in Russian rubles rather than US dollars. To avoid all these issues with the strength of the US dollar, if it does that, it exposes itself to political leverage in the future. If Russia needs a favor from Turkey, or it needs some sort of agreement from the country, it can use the amount of fuel that it is providing on favorable terms as leverage over President Erdogan and encourage him to support Russia. This is a concern for the global economy, and what this potentially could lead to is secondary sanctions being applied against them. There have already been discussions between NATO, the US, and Turkey about not wanting to see Turkey increase its trade with Russia and threatening to impose sanctions. As a result, there is a chance that in the future, if Turkey does cross the line from the viewpoint of the West, Turkey may be subject to sanctions itself and find itself in a situation similar to where Russia is at the moment. And it would be completely devastating for the Turkish economy. Hence, Turkey is currently balancing a lot of risks. The Turkish central bank is continuing with its interest rate reduction policy. However, when you step back from the current situation, it doesn't appear that this is the best course of action. This is the second consecutive month that interest rates have been reduced. So, it will be fascinating to see what happens for the rest of this year. What do you think will happen next for Turkey's economy? Do you think President Erdogan's ways will benefit or just make things worse for them? What risk does this pose to the rest of us? We will be very glad to hear about your thoughts in the comment section below. As usual, if you learned something valuable, please make sure to like, subscribe, and hit the notification bell for more contents like this. You can check out more videos on the channel and share. See you in the next one.